Hi, everybody, and welcome to the April 2025 Economic and Market Update presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. March was a tough month for U.S. stocks, capping off a very weak start to the year. All three major indices were down for both the month and the quarter. The Dow held up the best, while the tech-heavy NASDAQ did worst, getting hit on concerns about AI and growth as the tech megacaps slid back. While it was a rough start to the year for stocks, though, bonds did better as falling interest rates supported prices. The Bloomberg Aggregate Bond Index was up by about 2.5% for the quarter. International stocks also did well as both developed and emerging markets both ended the quarter in positive territory. Overall, this quarter was a good reminder that diversification can pay off in difficult times. But while the headline results were disappointing for U.S. stocks, when you look deeper into the market, things weren't so bad. For the market as a whole, 7 of the 11 economic sectors ended the quarter in the green. When you strip out the impact of the Magnificent Seven stocks, which were down roughly 15%, the remainder of the S&P was basically flat for the quarter. The weakness was much more concentrated than it seems, and this should be a positive going forward. The fundamentals were encouraging as well. We just finished fourth quarter earnings season, and the results were very constructive. The average earnings growth rate for the S&P 500 companies was over 14%, almost double analyst estimates. Over the long run, fundamentals drive performance, so this is a good sign going forward. And looking forward, the solid economic backdrop should keep driving earnings growth. The February jobs report showed continued hiring, with 151,000 jobs added. We also saw improvements in inflation, which was another good sign. But while hiring and inflation were positive, though, there were some signs of potential weakness ahead. Consumer confidence dropped in March, which could signal slower spending growth. Given the importance of consumer spending for the economy, this will be a key area to pay attention to. And of course, aside from the economic factors, there are also a number of other risks. Domestically, policy uncertainty remains the biggest one, as the planned rollout of tariffs continues to rattle markets. Beyond the domestic concerns, we also have foreign risks, such as the continued conflicts in Ukraine and the Middle East. There's a lot to keep an eye on, and a lot could happen. More market volatility is certainly possible, and we should be prepared to weather any of the potential turbulence ahead. But despite all of these concerns, on balance, we're still in a relatively good place, and the economic and market fundamentals are still supportive. Overall, despite the recent turbulence, the most likely path forward is still for continued economic growth and market appreciation. That's a good place to start the spring from. That's it for this month's update. Please join me again next month for the latest news, and in the meantime, stay safe, stay sane, and stay healthy. And thanks for watching.